Welcome to Goldbank.
Glad to be here.
So, we are looking at a very specific corner of a market right now. We have a UK-listed gold producer that has just put some fresh numbers on the table regarding what they expect to actually pull out of the ground.
Right, yeah. It is a moment where operational reality really meets market expectation.
And for anyone listening who watches the UK market, this is a prime example of a mechanic we talk about often. We have a headline number, sure, but the real story is how that number practically moves the share price.
Exactly. I mean, you can sit and watch the spot price of gold all day long. But for a mining company, the production guidance is really the gearbox. It is what actually translates that commodity price into equity performance.
Into actual returns for the investor.
Right. It shapes sentiment across the entire precious metal space, honestly.
Let's unpack that a bit. Why is guidance the absolute primary focus here?
Because guidance is, well, it's the absolute quickest way for an investor to figure out earnings. Like, if you're holding a mining stock, you already know what gold is worth.
Because that is public information. It's on the ticker.
Right. What you do not know, until the company actually tells you, is how much of that gold they're going to sell. So when a company releases a production range, it allows the market to sit down and do the math on revenue.
Revenue and then costs.
And costs, and ultimately cash generation.
So it anchors the model for everyone looking at the stock.
Precisely. It anchors expectations because
Yeah.
without that anchor, the share price is just sort of floating on vibes and sentiment. With it, you have a calculator and a real target.
Okay, let's get to the actual news then. We are talking about Pan-African Resources.
Yeah, a familiar name for the UK audience, I'd say. They are UK listed with their primary operations down in South Africa.
And they have put out their numbers for the financial year 2026. What exactly are we looking at?
The specific guidance they dropped is a total production range of 275,000 to 292,000 ounces.
275,000 to 292,000.
That is the bracket, yeah. And the reason this matters so much is that it is a clear, highly defined range. The company is effectively drawing a line in the sand for the next fiscal year.
And the market immediately uses this to calibrate.
They do. They use it to calibrate three very specific things.
Yeah.
First is revenue. Second is costs. And third is cash generation.
Right.
When you have a firm number like 292,000 ounces at the top end of that bracket, an analyst can immediately plug that into a spreadsheet, apply the current gold price, and arrive at a pretty solid cash flow prediction.
It just removes the guesswork.
It reduces it, certainly. And this brings us to the whole concept of credibility in the market. When a company like Pan-African puts out a range like this, there are basically two ways it can go.
Walk us through those two scenarios.
Sure. Scenario A is that the market believes them. They view the range as credible and actually achievable.
So if the market thinks Pan-African can hit that 275,000 or 292,000 target without any nasty surprises on the cost side, what happens?
It supports confidence, big time. Investors start to genuinely rely on that future cash flow. And then they start to price in shareholder returns, dividends, buybacks, that sort of thing.
Okay, and scenario B?
Scenario B is doubt. If investors look at that range and think, I am not really sure they can deliver that, or they think it will cost them way more than they are letting on to get those ounces, then the stock becomes incredibly volatile.
Even if gold is trading really high.
That is the crucial point for anyone listening, yes.
Yeah.
Even in a strong gold take, meaning an environment where the gold price itself is climbing a miner, can still really struggle if the market doubts their delivery.
Wow.
You can have a booming bullion market, but if you consistently miss your production targets, your stock will lag behind the metal.
That feels like a major lesson for the UK investor right there. These companies trade on operational updates just as heavily as they trade on the price of the actual metal?
Often more so, honestly. The metal price lifts the whole sector, like a rising tide, but the operational update determines who actually outperforms within that sector.
So looking at this specific update from Pan-African Resources, where do they stand? Are they a winner in this context?
I would definitely classify them as a winner here, yes. And the primary reason is that reduction of uncertainty. By providing this very clear FY 2026 guidance, they are sharpening how the market values the business.
It is all about visibility.
Correct. Uncertainty is usually penalized heavily by the market by saying, hey, here is our range, 275,000 to 292,000 ounces. They are simply removing a variable.
Investors do not have to guess if production is going to suddenly drop off a cliff next quarter.
Exactly. They have a perimeter to work within.
And that clarity, it has a broader connection to the market and is not just about Pan-African stock itself.
No, it connects to the wider ecosystem. When you see a producer like Pan-African giving solid, confident guidance, It reinforces confidence in gold-linked cash flows across the board.
Which perfectly brings us to the other winners we wanted to touch on today, the investment vehicles.
Right. We very often see a correlation here with things like the iShares Physical Gold ETC.
Explain that connection for us. Why does a single miner's guidance help a physical gold tracker?
It is entirely about sentiment. If Pan-African's guidance reinforces the idea that the gold sector as a whole is healthy and generating real cash, it adds to the bullish sentiment for the commodity itself.
It validates the asset class?
Exactly. It validates it. If the miners are confident enough to project strong numbers, it suggests the underlying market for the metal is functioning well. It supports vehicles that track the LBMA gold price.
And we also see this exact dynamic with Wisdom Tree Physical Gold.
Yes, and this touches on a very specific strategy we see all the time with UK investors. It is rarely an either-or situation for them.
Meaning they do not just buy the miner or just buy the ETF.
Right. Often when miners are flagging stable or strong production expectations, UK investors will pair that exposure.
They hold both at the same time.
They hold the miner for the operational leverage, the potential for much higher returns if the company executes its plan perfectly. And then they hold a simpler gold ETC, like the Wisdom Tree product, as a safety hedge or a core holding.
So Pan-African coming out and saying that they are steady actually encourages that specific portfolio construction.
It makes the whole trade feel much more secure. You have the risky asset, the miner performing exactly as expected, which allows you to hold the defensive asset, the physical gold ETC, with a lot more confidence.
That makes total sense. Now, we have to look at the other side of the coin. Pan-African has put out this clear, solid range. How does that make other players in the market look?
It naturally forces a comparison. And this is where we start to see some losers, relatively speaking. When one company offers absolute clarity and stability, companies that are cutting their guidance or missing their targets stand out much more starkly.
Let's start with Fresnillo.
Fresnillo is a huge name, but they are in a very different position here. They've recently cut their 2026 production outlook.
And that includes silver as well, right? Not just gold.
It does. And when you compare that directly to a producer like Pan-African, who is putting out a clear, steady forward range, Fresnillo just looks weaker on near-term delivery.
It goes right back to that confidence metric we were talking about.
It does. If Pan-African is scenario A credible and achievable, Fresnillo is drifting dangerously towards scenario B. The market looks at a production cut and immediately has to adjust its earnings models downward.
Which hurts the stock.
It creates a major headwind for the stock that has absolutely nothing to do with the gold price and everything to do with how much rock they can physically process.
Then we have Hochschild Mining. What is their story right now?
Hochschild is another really good comparison. Their issue isn't necessarily just the volume of metal, but the actual cost of getting it. Their 2026 outlook drew a lot of attention because the cost and capital guidance came in above expectations.
So they might be producing the gold, but it is just costing them more money to do it.
Exactly. And in a market that is desperately looking for cleaner margin visibility, that is a huge negative. Investors want to see that the revenue from a high gold price is actually flowing down to the bottom line.
Not being eaten up by higher operational costs or new equipment.
Right. Capital expenditure. If that eats the profit, investors walk away.
So even if the gold price is sitting at a record high, Hochschild is under pressure simply because the margin is getting squeezed.
Sentiment is pressured, yes. If investors are looking to reward efficiency, a company guiding for higher costs is going to really struggle to attract capital compared to one guiding for steady production at stable costs.
And finally, let's talk about Endeavor Mining.
Endeavor is a textbook example of where the fine details in the guidance really matter. We are looking at their FY 2026 numbers, and specifically their all-in sustaining costs.
The AISC, what is the actual number there?
They are guiding for an AISC range of roughly $1,600 to $1,800 per ounce.
$1,600 to $1,800.
That is what it costs them to get a single ounce out of the ground and sustain their current operations. Now think about what that means for their profit margin.
It means they need a really high gold price to make a substantial profit.
It makes them highly margin sensitive. If the price of gold pulls back even slightly, that $1,800 upper limit gets uncomfortably close to the selling price.
Whereas a lower-cost producer has a much bigger buffer to absorb a price drop.
Correct. The market constantly compares producers based on cost discipline. When you publish a guidance range of $1,600 to $1,800 AISC, you are essentially telling the market, hey, we are profitable, but we are extremely sensitive to the gold price.
So if gold dips?
If gold dips, their free cash flow evaporates way faster than a company with lower base costs.
So, in the context of winners and losers, Endeavor is viewed with a bit more caution right now.
It is definitely viewed as higher risk in any sort of downside scenario. Pan-African's update regarding production volume is one thing, but cost guidance like Endeavor's is what determines the actual safety of the profit margin.
It really highlights how incredibly different these companies are under the hood. You cannot just buy a basket of gold miners and expect them to all behave the exact same way.
No, you absolutely cannot. The headline commodity price affects them all, sure, but the guidance, the production volume, the costs, the capital expenditure, that is what actually differentiates the stock performance day to day.
So, bringing this back to the UK investor listening right now, we started with Pan African Resources and their 275,000 to 292,000 ounce range. What is the absolute bottom line here?
The bottom line is that Pan-African is explicitly telling the market what it aims to produce in FY 2026. They are putting a hard number on the board.
And that number drives real action.
It drives near-term positioning, not just in Pan-African stock, but across the sector. It sets a baseline benchmark. It tells investors, look, this is what a steady operator looks like right now.
And it forces those tough comparisons we just went through.
It does. It forces you to look at Fresnillo, Hochschild, and Endeavor and ask, why aren't their numbers as clean? Why are their costs creeping higher? Why are they actively cutting output?
So for you, the listener, whether you are holding these stocks or just thinking about them, the main takeaway is to look past the gold price ticker on your screen.
Look at the guidance. That is where the company tells you the truth about its business. That single production range from Pan-African drives is positioning in UK-listed precious metals miners more broadly because it resets the standard for what is expected.
Operational clarity really dictates the winners and losers.
It is the currency of trust in the mining sector.
Before we go, something to chew on. We spend all this time dissecting how miners project their yields based on what is in the ground. But think about the massive rise in electronics recycling and urban mining. E-waste is becoming a richer source of precious metals than some traditional ore bodies. If the technology to extract gold from old smartphones scales up dramatically, these primary production forecasts from traditional miners might face a completely different kind of competition in the next decade. Something to watch.
Absolutely.
That seems like the right place to leave it. A clear range, a clear reaction, and a market that is always checking the math.
Always.
Thanks for tuning into Gold Bank. We will catch you next time.